The silver market is entering a phase that most investors are completely unprepared for. While everyone's been watching the headlines and tracking the daily price movements, something far more significant has been building beneath the surface. And if you're holding silver right now or thinking about getting in, what I'm about to show you changes everything about your timeline for action. Let me start with a question that should keep you up at night. What happens when the world's most critical industrial metal, the one that powers everything from solar panels to electric vehicles to military defense systems, enters its sixth consecutive year of supply deficit while demand continues accelerating? We're not talking about a temporary imbalance here. We're talking about a structural shortage that's been compounding year after year, and the window to position yourself ahead of what's coming is closing faster than most people realize. Here's what the institutions know that retail investors don't. The silver market isn't just tight. It's being stretched to a breaking point that we haven't seen in modern history. Industrial demand alone has consumed hundreds of millions of ounces that can never be recovered. Unlike gold, which sits in vaults and can be recycled endlessly, silver gets used up. It gets embedded in circuit boards, solar panels, and medical devices. It's gone. And every year, industry needs more of it, while the earth is giving us less. The mining companies will tell you they're increasing production, but here's what they won't tell you. Primary silver mines, the ones that dig specifically for silver, have been declining for years. Most silver today comes as a byproduct of copper, lead, and zinc mining. So when those base metal prices drop or those mines slow down for any reason, silver supply gets choked off as collateral damage. The miners don't have a switch they can flip to suddenly produce more silver when the price spikes. It takes years to bring new mines online, and right now there aren't enough projects in the pipeline to close the gap. Now, let me show you something that should make your palms sweat. Investment demand for physical silver has been climbing steadily while the supply deficit deepens. Think about what that means. You've got industry consuming more silver than ever before, you've got a supply deficit that's been running for 6 straight years, and now you've got investors waking up to the opportunity and starting to accumulate physical metal. It's like watching 3 freight trains heading toward the same intersection, and everyone's pretending they won't collide. The smart money has already figured this out. Central banks have been accumulating gold at record pace, but what most people miss is the parallel move happening in silver. Institutional investors, the ones managing billions in assets, have been quietly building positions in silver ETFs and physical holdings. They're not doing this because they think silver might go up 5 or 10%. They're positioning for a supply crisis that could send prices into territory that seems impossible right now. Before we go further, I want to make sure you have access to the information that could protect your wealth through what's coming. I put together a free guide in the description below that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's completely free, and it could be the difference between watching this crisis unfold and being positioned ahead of it. Check the description after this video. Now, let me take you back to a moment in history that rhymes with what we're seeing today. In the late 70s, silver was trading around $5 an ounce. Most investors ignored it. They thought it was just an industrial metal, nothing special. But a few people understood what was really happening. They saw the supply constraints, the monetary instability, the loss of confidence in paper currencies, and they watched silver climb from $5 to $50 in less than 2 years. The people who positioned themselves early didn't just make money. They preserved their purchasing power through one of the most turbulent economic periods in modern history. But here's what makes today different and potentially more explosive. Back then, silver's industrial demand was a fraction of what it is now. Today, silver is absolutely critical to the technologies that are supposed to save us. Solar panels need silver. Electric vehicles need silver. 5G networks need silver. The green energy transition that governments around the world are mandating requires massive amounts of silver, and there's no substitute that works as well at any price point. So while investment demand can ebb and flow, industrial demand just keeps grinding higher, consuming supply that can never come back to the market. The COMEX, the exchange where silver futures trade, has been showing some very interesting stress signals lately. The amount of physical silver available for delivery has been declining, while open interest, the number of contracts betting on future prices, has been climbing. This is the classic setup for a squeeze. When too many people hold paper claims on physical metal that doesn't exist in sufficient quantities, something has to give. Either the price explodes to ration the available supply, or the paper market breaks and people lose faith in the whole system. Neither outcome is good for people who waited too long to get positioned. Let me paint you a picture of what's happening right now in the physical market. Dealers are reporting delays in getting product. Premiums, the amount you pay above the spot price for physical coins and bars, have been elevated for months. This tells you that the paper price you see on the screen doesn't reflect the reality of actually getting your hands on physical metal. There's a disconnect forming between the price discovery mechanism and the physical market, and that disconnect always resolves in favor of physical. Always. The question is just how violent that resolution will be. The geopolitical situation adds another layer of urgency that most people aren't factoring in. We're watching the global monetary system fracture in real time. Countries are moving away from dollar dependence, building alternative payment systems, accumulating gold and silver as monetary reserves. When trust in paper currencies erodes, people don't flee to other paper currencies. They flee to tangible assets that have held value for thousands of years. Silver, with its dual role as both an industrial metal and a monetary metal, becomes incredibly attractive in that environment. Think about the psychology of what's coming. Right now, most investors are complacent. They think the system is stable, that central banks have everything under control, that supply and demand imbalances work themselves out naturally. But what happens when that confidence cracks? What happens when people realize that the silver they need for their solar installation or their investment portfolio isn't readily available at current prices? You get panic buying. You get a rush for the exits that overwhelms the available supply. And by the time the mainstream media is covering the silver shortage, it's already too late to get in at reasonable prices. The industrial users of silver are starting to get nervous. Companies that need silver for manufacturing are beginning to stockpile, building inventories as insurance against supply disruptions. When industrial users start hoarding, that's a massive red flag. These are sophisticated buyers with deep knowledge of the supply chain. They're not stockpiling because they think prices might go up a little. They're stockpiling because they're genuinely worried about being able to get the metal they need to keep their production lines running. And every ounce they stockpile is one less ounce available for everyone else. Now, here's where this gets personal for anyone thinking about retirement security. The traditional 60-40 portfolio of stocks and bonds that financial advisors have been pushing for decades is completely unprepared for the kind of monetary instability we're heading into. When inflation runs hot, bonds get destroyed. When markets crash, stocks get destroyed. But physical precious metals, especially silver with its supply deficit and industrial demand, have historically provided the kind of protection that paper assets simply cannot deliver. I need to take a quick moment here because this is important. If you're sitting on retirement accounts worth over $100,000, you need to understand how gold IRAs work. I've put together a comprehensive guide that's in the description below. It covers exactly how you can get physical gold into your retirement account without triggering tax penalties. This isn't about speculation. This is about protecting wealth you've spent decades building from the currency debasement and market instability that's accelerating around us. The guide is free, it's educational, and it could be one of the most important financial decisions you make this year. Worth checking out if you're serious about protecting what you've built. Back to the silver story, because what's coming next is where this really gets interesting. The ratio between gold and silver prices has been historically out of whack. For most of human history, silver traded at ratios to gold ranging from 15 to 1 up to about 30 to 1. Right now, we're seeing ratios that are significantly wider than historical norms. What does that tell you? It tells you that either gold is overvalued relative to silver, or silver is dramatically undervalued relative to gold. Given the supply deficit in silver and the industrial demand dynamics, which scenario seems more likely? When that ratio starts to correct, and it will correct because these imbalances always eventually resolve, the move in silver will be explosive. We're not talking about silver matching gold's percentage gains. We're talking about silver potentially outperforming gold by multiples as the ratio compression plays out. The people who understand this dynamic and position themselves accordingly won't just preserve wealth. They'll build wealth during a period when most people are watching their purchasing power evaporate. Let me tell you about something that happened in the silver market that most people have forgotten. Back in the early 2000s, there was a period where silver was trading in the single digits. Industry was consuming it, Supply was tight, but investors weren't paying attention. Then, over the next decade, silver went on a run that took it from under $5 to nearly $50. The people who got in early and held through the volatility saw their positions multiply by 10 times or more. But here's the key. They didn't wait for confirmation. They didn't wait for the mainstream media to tell them it was safe. They looked at the fundamentals, understood the supply and demand dynamics, and took action while everyone else was still sleeping. Still, the window we're in right now feels eerily similar to those early days. The fundamentals are actually stronger now because industrial demand is so much higher and the supply deficit has been running for so much longer. But the investor awareness hasn't caught up yet. Most people still think of silver as just another commodity, something that goes up and down with no particular reason. They don't understand that we're in the middle of a structural supply crisis that's been years in the making and is about to reach a critical inflection point. The solar industry alone is projected to consume massive amounts of silver over the next decade. Every solar panel needs silver paste for the electrical contacts. There's no economically viable substitute. As countries around the world mandate renewable energy transitions and subsidize solar installations, that demand is locked in. It's not speculative. It's not dependent on investor sentiment. It's industrial consumption that has to happen regardless of price. And when you combine that with electric vehicle demand, 5G infrastructure, and all the other technological applications that require silver, you're looking at a demand profile that's unprecedented in history. Meanwhile, the supply side of the equation keeps getting worse. Ore grades at existing mines are declining. The easy silver has already been mined. What's left requires more energy, more processing, more capital investment to extract. And with energy costs rising globally, the cost of production for silver keeps climbing. At some point, and we may be approaching that point now, the paper price of silver becomes disconnected from the actual cost of getting it out of the ground. When that happens, miners cut production, supply tightens further, and the price has to rise to incentivize new production. It's basic economics, but the implications are profound. Here's something that should terrify anyone who's not positioned in physical silver. The paper silver market is enormous compared to the physical market. There are far more claims on silver in the form of futures contracts, ETFs, and other derivatives than there is actual physical silver available to deliver. This works fine as long as everyone's content to trade paper, and nobody asks for physical delivery. But what happens when confidence in the paper market cracks? What happens when investors start demanding physical delivery of the metal they supposedly own? You get a run on the bank, except this bank is the entire paper silver market, and there's no Federal Reserve that can print more silver to bail it out. The Chinese have been accumulating silver quietly for years. They understand the strategic importance of controlling critical materials. They've seen what happened with rare earth elements, where they cornered the market and now have pricing power over materials essential to modern technology. Silver is next on that list. As China continues to build out its solar capacity, its electric vehicle infrastructure, its 5G networks, they're going to need enormous amounts of silver. And they're not going to want to be dependent on Western markets or Western pricing mechanisms to get it. They're going to want to control the supply chain, which means accumulating physical metal now while it's still available. Think about what that means for Western investors. If China decides to restrict silver exports or prioritize domestic consumption, where does that leave the rest of the world? It leaves them scrambling for supply in a market that's already in deficit. It leaves them bidding up prices to secure the metal they need. And it leaves individual investors who waited too long on the sidelines, watching prices climb to levels they never thought possible while they're unable to get physical metal at any reasonable price. The banking system's exposure to precious metals derivatives is another factor that doesn't get enough attention. Major banks hold enormous positions in silver derivatives, often on the short side, betting that prices will stay contained. But what happens if they're wrong? What happens if the supply deficit finally overwhelms their ability to manage the paper price? You could see a derivatives crisis in the precious metals market that makes previous financial crises look tame by comparison. And when that happens, the flight to physical metal will be unlike anything we've seen in modern times. I want you to understand something crucial about timing. Markets can stay irrational longer than you can stay solvent, as the saying goes, but they can't stay irrational forever. The laws of supply and demand eventually assert themselves, often violently. We're in the late stages of a supply deficit that's been building for 6 years. Industrial demand keeps climbing. Investment demand is starting to wake up. The paper market is showing stress. All the pieces are in place for a move that will catch most investors completely off guard. The people who will profit from what's coming aren't the ones who wait for confirmation. They're not the ones who need the mainstream media to validate their thesis. They're the ones who look at the fundamentals, understand the trajectory, and take action while there's still time. They're the ones who recognize that in markets, you get paid for being early, and you get paid for being right. But you get paid the most for being early and right. And right now, we're in that window where being early still means you can get positioned at prices that will look absurdly cheap in hindsight. Let me give you a framework for thinking about this. Imagine you're looking at a dam that's been holding back water for years. Every year, more water accumulates behind that dam. Every year, the pressure builds. Engineers keep saying the dam is fine, that it's designed to handle the load. But you can see the cracks forming. You can see the stress points. You can see that the rate of water accumulation is accelerating while the dam's structural integrity is declining. Do you wait for the dam to break before you move to higher ground? Or do you recognize the trajectory and take action while you still can? That's where we are with silver. The dam is the paper price suppression mechanism, the derivatives market, the managed perception that everything's fine. The water is the supply deficit, the industrial demand, the investment demand that's starting to build. The cracks are the delivery delays, the elevated premiums, the stress in the comics warehouse stocks, and the trajectory is clear to anyone willing to look at it honestly. The retirement implications of this cannot be overstated. Most people have their wealth tied up in financial assets that are denominated in currencies that are being systematically debased. They're trusting that the system will remain stable, that their purchasing power will be preserved, that they'll be able to retire with dignity. But what happens when inflation runs hotter than expected? What happens when the currency crisis that's been building finally arrives? What happens when the supply deficit in critical materials like silver causes price spikes that ripple through the entire economy? The people who will weather that storm are the ones who diversified into tangible assets before the crisis hit. They're the ones who understood that paper promises are only as good as the institutions making them, and those institutions are showing cracks. They're the ones who recognize that physical precious metals, especially silver with its unique supply and demand dynamics, provide protection that no amount of financial engineering can replicate. Here's what keeps me up at night. The general public has no idea how fragile the current system is. They don't understand the derivatives exposure, the supply deficits, the currency debasement, the geopolitical fracturing. They're going about their daily lives assuming that tomorrow will look like today, that the system is stable, that their wealth is secure. And when reality finally breaks through that comfortable illusion, the scramble for safety will be chaotic and brutal. The people who position themselves ahead of that moment won't just survive it. They'll thrive while others are trying to figure out what happened. The silver market is small. The entire above-ground supply of investment-grade silver is worth a fraction of what major tech companies are worth. When serious money decides to move into silver, when institutional investors and sovereign wealth funds and pension funds start allocating even a small percentage of their assets to physical silver, the available supply will be overwhelmed almost instantly. Prices will gap higher, premiums will explode, and availability will evaporate. By the time that happens, it's too late to get positioned at anything resembling current prices. I want to be very clear about something. This isn't about speculation. This isn't about trying to time the market perfectly or catch every short-term move. This is about recognizing a structural imbalance that has been building for years and is approaching a critical inflection point. This is about understanding that the window to position yourself ahead of what's coming is finite and closing. This is about taking action based on fundamentals that are undeniable to anyone willing to look at them honestly. The choice you face is simple but profound. You can wait for more confirmation, for more evidence, for the mainstream media to finally acknowledge what's happening. By then, prices will be multiples higher, and physical availability will be severely constrained. Or you can look at the evidence that's already in front of you, understand the trajectory, and take action while there's still time. The fundamentals are clear. The supply deficit is real. The industrial demand is accelerating. The investment demand is building. The paper market is showing stress. All the pieces are in place. For those of you who've made it this far, who've stuck with me through this entire analysis, I want to make sure you have access to the resources that can help you take action. That free guide I mentioned earlier, the one in the description, it's not just information. For American retirees with at least $100,000 in retirement accounts, I'm offering an exclusive one-on-one educational web conference. No obligation, no pressure, just education about how to protect the wealth you've spent decades building. This is only available to people who mention they watch this video, and it's only available while spots remain. If you're serious about protecting your retirement from what's coming, check the description and take advantage of this while you still can. The silver stackers who understand what's happening, who've been accumulating physical metal while everyone else was distracted, they're not going to have a closing window. They're going to have an opening opportunity. They're going to watch their positions appreciate as the supply deficit finally overwhelms the paper price suppression. They're going to have the tangible wealth that holds its value when paper assets are getting destroyed. They're going to be positioned for what's coming instead of scrambling to react after it's already here. The question isn't whether the silver supply deficit will resolve. It will. The laws of supply and demand are immutable. The question is whether you'll be positioned ahead of that resolution or caught scrambling after it happens. The window is closing. The fundamentals are screaming. The smart money is already moving. What are you going to do?